you're still okay with taking ownership of the shares, right? That doesn't change. All four of these strategies, the naked put that you sell during for the wheel strategy, you're okay with taking ownership. The covered call, you already have ownership of the shares when you do a covered call. The collar strategy, you have ownership of the shares when you do a collar. So you obviously okay with having ownership of the shares at that point. And this Bionic Bull is the same thing. But this gives you unlimited upside. It's so you can hit a home run, you can hit a grand slam on something that you're doing this kind of safeguard strategy with. You can't hit a home run with the wheel strategy. Let's talk about what we are going to discuss this evening, and that's doing the safeguard strategy on an IRA account or in an IRA account, and or trading in a kind of buy and hold type of trading strategy using the safeguard type of process that we talk about quite often. But I'm going to try to break it down in small steps here.
Please subscribe to our channel. Happy trading!
So you've probably heard of the wheel strategy, and the wheel strategy consists of selling a naked put, and then if you are assigned shares, then selling what is called a covered call. Okay? So the naked put is a way you can get into some shares for a discount. So let me show you this with Apple. So let's just say we wanted to trade Apple with 33 days ago, and we were okay with taking ownership of Apple that's currently trading, or on Friday when it closed, just under 181. And let's just say we would be in love with trading Apple or owning Apple around 170. So that would be $10 drop that you would have to take. You're okay with taking ownership of Apple. That's the premise here. And you're okay with taking ownership of Apple at the 170 strike. It's currently trading basically at 181. So that's a drop about $11 and expire at that point at expiration below 170. If that's the case, your cost basis would be about just under 169, because you're going to be collecting at least 119 if you sold this naked put. Okay? And so, but if Apple does drop, and dropping is going in this direction on an option chain, and let's say it expires below 170, then you would have to take the ownership of the shares, and then that's when you do what is called a covered call. A covered call is like owning a house and renting it out. If you own 100 shares of any company that has options attached to that company's trading stock, then you can treat those shares as if it was a property. And you can treat it as an asset. It's obviously an asset, but you can rent that asset out just like you can with a house. You can Airbnb out if you want it. You can do a daily rental, you can do a weekly rental, you can do a yearly rental. You can decide how you want to execute the selling of the covered call. And when you do a covered call, it's like this: you own the shares, and then you sell it at a higher price. You can sell it at a lower price. You decide where you want to sell that covered call at. Regardless, you're going to collect some type of credit for it, because someone's going to pay you for selling it. So normally what people do is they sell the covered call out of the money. So if it's currently trading at about 181, someone will sell it at 185 or 190 or even 195. You decide. But if that's the case, what would happen is that if Apple jumped up to 195, then you would make 1460 if your cost basis was, let's say, 183 or 181. If your cost basis was 181, you can have the potential to make 1460 if it expires above the 195. But just like with, if you have a property and you're renting it out, and say you give somebody the type of contract to rent to own, well, if it goes to the level that you agreed on, then they have the right to purchase your house at that point. So for example purposes, let's say you had a house that was 100K and you rent to own for 125K, just for example purposes. Well, you tell the person within the next 33 days or whatever the time frame is, if you buy my house within that time frame for 125,000, then I'll give it to you. Right? You'll have it. So you'll make a profit of 25K, not including closing price and things like that, right? Not including fees, but you'll make 25K. That person have to buy your house for that point. But if they don't do it within the time frame, then the contract is over. You get to keep the premium that they paid you for that contract, and then you have to do it all over again. And so next time you can decide, okay, well, I'm not going to give you the 125 offer. Well, I'm going to give you the 150 offer now. Right? So I'm going to get another 25K if I have to give up my property. And that's the same kind of concept you can do with shares. You can literally treat it as an asset that you can rent out, and that's called the covered call. Right? And so that's the normal wheel strategy. The wheel strategy is literally you start with the naked put that we just went over, and then if you have to take ownership of the shares, because when you sell a naked put, you're bullish, but you have the obligation here. You have the obligation to purchase at 170 if it drops below 170, or if the buyer of the put wants to exercise their right. Normally, they're not going to exercise their right until expiration and or it's in the money, but it's usually at expiration. Okay, and you sell that naked put, you have the obligation to purchase the shares. So you purchase the shares, and at that point, you have that asset that you can rent out. That is the wheel strategy. Okay? But at the Dorian way, we throw in two other strategies that we call the safeguard strategy. Okay? I think the wheel strategy is fine, but we try to create an improved, a better version of the wheel strategy. Okay? Because the wheel strategy, you always start with the naked put and then you go to the covered call. With the safeguard strategy, you can start with any of the four strategies that we recommend, right? So, for example purposes, the third type of strategy that we recommend with the safeguard strategy is what is called a collar strategy, right? COLLAR, the collar strategy. And the collar strategy is taking a covered call, you're doing the covered call, and then the monies that you receive for the call you sell, right? That you sell, you take some of those monies and you buy a put. So in this example here, you have risks all the way to zero for this covered call. Apple's not going to go to zero anytime soon, but you do theoretically have risks all the way to zero if you do a covered call, right? It's better than buying the shares outright because your risk is greater all the way to zero. It's bigger. But if you do the covered call, it's less, but you still got risk, a decent amount of risk. But if you take some of these monies, and let's just say it's $3, and you take some of that and you buy a put, then if you look over here at this max loss, it's going to change a lot, right? So if we buy this put at the 170, then our max loss is dropped to $935. Right? So the max loss before was 17 plus $1,000. Now it's only 935 because when you buy a put, it gives you the right to purchase at that point. So if you had 100 shares, this put equals 100 shares. So you stop losing once it goes below 170. Just like when you are doing the covered call and when you're renting out the asset that you have, those shares, you stop winning if it goes past the call that you sell. So this is a collar. You kind of bracketing in your risk to the downside and your upside potential. Okay, you're limiting your downside and limiting your upside potential when you're doing a collar strategy. So this collar strategy is it's a bullish strategy. Right? Don't be mistaken. As you can see here, if we were doing this right now, if we were initiating the trade with a collar strategy, it's still 44, almost 45 long deltas. So that's still bullish. You want it to go up. The naked put in the wheel strategy is bullish. The covered call in the wheel strategy is bullish. This collar strategy in the safeguard process that we do is also bullish. But it protects you the most to the downside is this collar strategy. You cannot lose within this next 33 days more than 170. So if something happened to Apple, like they went out of business because some crazy Enron situation occurs, well, you will not lose more than 170. Everyone else obviously would lose all their money at that point if they didn't have this type of collar on. Okay? So this is a way to protect yourself a lot more, especially when you think something is that is it potentially can go down a lot or it's been going up a lot and you're afraid it's going to pull back. You can use this collar strategy to minimize your downside on any stock that has options attached to it. Okay? Any stock that has options attached to it, you can exercise this collar strategy almost 100% of the time. Okay? Nothing's 100%, but almost 100% of the time. So that's the third strategy that we introduce with the process that we call, or the strategy we call the safeguard. Okay? The fourth and last type of strategy, and there's some deviations that we're going to talk about here in a second of these strategies, but the fourth and last is what we call the Bionic Bull. So when you're doing a wheel strategy, and I'm trying to just give you a comparison, right? When you're doing the wheel strategy, when you sell that naked put, the most you can make is the premium that you receive, right? You don't have unlimited ability to the upside. It's when you're an option seller, most of the time, the most you can make is what you receive by the credit. Okay, that's the most you can make. When you do the covered call with the wheel strategy, you do not have unlimited upside. Okay? You do not have unlimited upside. The most you can make is up to the call that you sell. Right? So if you sell it at the 185, that's when you stop winning. If you sell it at the 195, that's when you stop winning. Okay? Now, when you do the collar strategy, and let's add this put here. When you do the collar strategy, then you also have limited upside, right? You minimize your downside. You don't have risk all the way to zero, but you still have limited upside. And so if we sold this 190 call, that's where we'll stop winning if it goes up. I just mentioned that the collar strategy is bullish. So so far, all three of these strategies are bullish. You want it to go up, and they all have limited upside. They all have limited upside. But the fourth strategy that we use is what we call the bionic bull. Okay, it's called the bionic bull, and it's the selling of a naked put and the buying of a call. If you are the buyer of a call, to say just a single call, then you have unlimited upside potential within that expiration period that you're doing it. So in this example, within the next 33 days, we have unlimited upside with this call. Okay? But it's going to cost us about 310, 305 if we were just going to buy this call outright. Okay? We can buy this call outright, and we would have a very, very small probability of winning at expiration, less than 30%, as the TastyTrade platform is indicating here. Okay? If we held this expiration, we would have less than a 30% chance of winning on that call that we purchased. But theoretically, yeah, we would have unlimited upside, as this is indicating here, right? This is like infinity to the upside, right? But what if we sold a put that financed the buying of this call? How would that change our probability? Okay? How would that change our probability, and how would that change our max potential profit? Okay? If we sell this put at the 180, you can see now this changes from a 30% chance to a 55% chance of winning at expiration. So now you got greater than a coin flipping chance, greater than a 50-50 chance if you sold this put to buy the call. And as you can see, you still have unlimited upside, right? You still have unlimited upside. Your risk to the downside is the same as if you would just sell the naked put by itself. Okay, your risk to the downside is the same if you just sold the naked put by itself. So you're when you do this bionic pool, you're still okay with taking ownership of the shares, right? That doesn't change. All four of these strategies, the naked put that you sell for the wheel strategy, you're okay with taking ownership. The covered call, you already have ownership of the shares when you do a covered call. The collar strategy, you have ownership of the shares when you do a collar. So you obviously okay with having ownership of the shares at that point. And this bionic bull is the same thing, but this gives you unlimited upside. It's so you can hit a home run, you can hit a grand slam on something that you're doing this kind of safeguard strategy with. You can't hit a home run with the wheel strategy. Okay, I'm not saying the wheel strategy is not something good. I'm just saying this is the safeguard strategy that we do at the Dorian way. It's just an improvement. We believe it's a better way to execute the wheel strategy.